Hello and welcome. When we think about investing, we often focus on the math, the interest rates, the price-to-earnings ratios, the historical returns. We spend our time looking for that perfect stock or the ideal asset allocation. But what if I told you that the single biggest obstacle to building wealth isn't your investment strategy? It's you. More specifically, it's the hardwired biases and emotional shortcuts in your own brain. The field of behavioral finance has shown us, time and again, that we are our own worst enemies when it comes to money. You see, the market doesn't beat most investors, investors beat themselves. In this video, we're not going to talk about what to invest in, we're going to talk about how to invest. We'll do this by understanding the mental traps that cost people thousands, even tens of thousands of dollars. We lines uncover 5 of the most common and costly behavioral biases that trip up investors and give you the tools you need to outsmart them. So, let's get started. First up is bias number 1, loss aversion. This is arguably the most powerful bias in all of finance. Loss aversion is the psychological principle that the pain of losing $100 is about twice as intense as the pleasure of gaining $100. Think about that for a second. We are hardwired to feel losses much more acutely than gains. This has a huge impact on our investing behavior. It's the reason so many people panic sell during a market crash. Watching your portfolio value drop is physically painful, and the natural human instinct is to sell to make that pain stop. The problem is, this often happens right at the market bottom. You end up locking in permanent losses just to avoid temporary, on-paper ones. So what's the cost? It's selling in a downturn and missing the subsequent recovery. Imagine if you had sold at the bottom of the 2008 financial crisis. You would have locked in a 50% loss and completely missed the multi-year bull market that followed. That single emotional decision could have cost you hundreds of thousands of dollars in future growth. The antidote to loss aversion is to focus on the long-term story, not the daily price quotes. Remember that market downturns are a normal, healthy part of investing. Instead of asking, "How much have I lost today?" ask yourself, "Has my long-term reason for owning these investments actually changed?" If the answer is no, then the best move is often no move at all. This brings us to our second mental trap, recency bias. This is our tendency to give too much weight to our most recent experiences and assume that the immediate past will predict the future. When tech stocks are soaring, we assume they'll soar forever. When a particular mutual fund has had 3 amazing years, we pile our money in, convinced it's a sure thing. Recency bias is the engine behind every market bubble and the primary reason people buy high. They see a trend and just assume it will continue indefinitely into the future. The cost here is obvious. You buy at the peak of a bubble and then suffer devastating losses when the trend inevitably reverses. Think about the dot-com bubble in the late 90s, the housing bubble before 2008, or even the recent crypto mania. In every case, people who chased performance after massive runs were often the ones left holding the bag when it all came crashing down. So, how do you fight it? Be a contrarian. Practice discipline. The time to get truly interested in an asset is often when it has been performing poorly for a while, not when it's making headlines every single day. Stick to your asset allocation and rebalance your portfolio regularly. This forces you to systematically buy low and sell high, the exact opposite of what recency bias tells you to do. Next up, we have bias number 3, confirmation bias. This is our natural tendency to seek out, interpret, and remember information that confirms what we already believe, while ignoring or dismissing information that contradicts our beliefs. Let's say you buy a stock because you believe it's a guaranteed winner. You will naturally start seeking out positive news and analyst reports about it. You lines subconsciously dismiss a critical article as just missing the point or not understanding the business. You essentially fall in love with your investment, and it becomes harder and harder to see its flaws. The cost of this is holding on to a losing investment for far too long. You ignore the red flags and the deteriorating fundamentals because you're only listening to the choir that agrees with you. This can turn a small, manageable loss into a catastrophic one. The antidote is to actively seek out the devil's advocate. Before you make an investment, make it a rule to write down the top 3 reasons not to buy it. Periodically, ask yourself, what would have to be true for this investment to be a bad one? You have to force yourself to confront opposing viewpoints. It's uncomfortable, but it's crucial for making rational decisions. This leads us right into bias number 4, the sunk cost fallacy. This is our tendency to continue an endeavor simply because we've already invested money, effort, or time into it. We tell ourselves things like, "I can't sell this stock now. I've already put so much into it, and I'm down so much." The key thing to understand is this: the money you've already lost is gone. It's a sunk cost. It should have zero bearing on your decision about the future. The only question that matters is, looking forward from today, what is the best decision for my portfolio? The cost of this fallacy is throwing good money after bad. You keep pouring money into a sinking ship because you can't bear the thought of admitting you were wrong, which only compounds your initial error. You miss out on better opportunities because your capital is tied up in a loser. The antidote here is to practice a little mental accounting. Wipe the slate clean. Ask yourself this powerful question: if I received the cash value of this investment today, would I use that cash to buy this exact same stock or fund all over again? If the answer is no, then you should probably sell. Finally, we have bias number 5, herd mentality. This is our instinct to follow the crowd. There is a deep-seated psychological comfort in doing what everyone else is doing. If everyone is buying, it must be the right thing to do, right? This bias is what creates investment manias and panics. It's the fear of missing out, or FOMO, that drives a bull market higher. And it's the fear of being the last one holding on that fuels a crash. The cost is huge. It leads you to buy at the top of a bubble and sell at the bottom of a crash. You're essentially letting the emotional state of the market dictate your financial decisions, which is a perfect recipe for buying high and selling low, over and over again. The antidote is to have a plan and automate it. The single best way to avoid getting swept up in the emotion of the crowd is to have a written investment plan. Decide on your asset allocation, set up automatic contributions, and then stick to the plan no matter what. As the famous saying goes, be fearful when others are greedy, and greedy when others are fearful. So, let's do a quick recap of these 5 costly biases. We have loss aversion, which is letting the fear of losses cause you to panic sell. There's recency bias, which makes you chase performance and buy at the top. We talked about confirmation bias, where you ignore warning signs about your own investments. Then there's the sunk cost fallacy, holding on to losers because you're emotionally attached. And finally, herd mentality, following the crowd right off a cliff. The common thread through all of these, they are all about emotion overriding logic. The market is a powerful tool for transferring wealth from the emotional to the disciplined. Building wealth isn't about having a genius-level IQ. It's about having a high EQ emotional intelligence. It's about patience, humility, and the discipline to stick to a simple plan even when, and especially when, it feels uncomfortable. By simply being aware of these biases, you've already taken a massive step toward outsmarting them. The most important investment you can ever make is not in the market, it's in understanding your own brain. Thanks so much for watching. If you found this helpful, please give this video a like and subscribe for more content on smarter investing. See you next time.